Okay, so I think we can, my clock showing it's 1 o'clock, and we can begin. Good afternoon, and welcome everyone. My name is Eric Mako. I'm an attorney with Mintz Levin's Clean Energy Group, and I have the privilege of moderating what I think will be a very interesting discussion today. This is the second of NECEC's series of 5 webinars on investor and corporate partner readiness. Today we've got a great case study about digital lumens and Astra Capital, which we think highlights the benefits of an investment from a VC with strategic partners. We have 2 great speakers today who I'll introduce to you in just a minute. But let me first run through the flow of how things are going to go this afternoon and mention just a couple of housekeeping items. I hope everyone can see the slides. We won't share them, but we are recording the webinar, and we will share a link to the recording with everyone when the event is over. Next slide. So thank you first to our sponsors, Mass Clean Energy Center and NYSERDA, MassCEC and NYSERDA sponsor us and help drive innovation acceleration in the clean energy sector throughout the Northeast. For NECEC, the Northeast includes New York and the 6 New England states. The council has an extensive network of investors, corporate partners, customers, and service firms such as Mintz. Everything that a clean tech startup needs to help them grow and scale their business in the region and across the country. Next slide, please. Great. So the agenda today, we will start by hearing from our 2 speakers, Jean-Marc from Astra Capital and Tom Pinsons from Digital Lumens. We'll hear about their organizations, about their story, and about this investment and partnership. I'll start off the Q&A with some questions to the speakers, and then we'll open it up for Q&A from the audience. But we have everybody muted here except for the speakers. So if you have questions as we're talking, go ahead and submit them through the Zoom chat function. Address them to Sean Davenport. And if you want to just go ahead and submit them as you think of them, there's no need to wait until we get to the audience Q&A section. We'll get those queued up and take them as we get them. So as I said, everyone's muted. We'll pick the questions that you're submitting to send along to the speakers. And I guess at this point, let's just go ahead and next slide, please. We just talked about that. And I'll introduce the speakers briefly. Jean-Marc Bailey is managing partner of Astra Capital. He's based in Paris. And we have Tom Pinsons, CEO of Digital Lumens, a Boston-based startup that was recently acquired by Osram, which is a leader in the commercial LED lighting solution space. Aster Pim is kindly operating our system for us. I believe he's on mute today, and myself, Eric Mako with Mintz Levin. So with that, I guess I'll turn it over to Jean-Marc to kick things off, talk a little bit about Astra Capital, about how he thinks about strategic partnerships in his portfolio, and about in strategic partners for prospective investments. Jean-Marc.
I'm managing partner at Aster. We are located in San Francisco, Paris, and Tel Aviv. And we are managing a $500 million fund under management, fund assets in the venture. We have been active for the last 17 years, and especially in the field of energy industry and mobility. We are mainly financed by corporation, some of them being Schneider Electric, Alstom, Solvay, Plastic Omnium, and some financial institutions like European Investment Fund, AFD, OFID, Proparco, and so on. and we have different set of funds. The last generation of fund that we have been announced has been the 240 million fund that we recently did the first close, dedicated at the energy, mobility, and industry again field. The main priority to maybe point out for Aster is related to the subject of today, and it is clearly about the capacity to bring a kind of business development support to portfolio companies, especially. So we define us as a platform VC, where within the platform VC, we have a kind of accelerator or business development accelerator, which we call Business Hub. And the particularity of this Business Hub is that it's made, or the team, it's a dedicated team at helping companies to develop their business by mainly leveraging a corporation that we have as LPs in the fund. And the way this team is dedicated at, it's really trying to find ways to find the right person, to close partnership, to close market access, to do some research and technology support on any kind of field of interest for portfolio companies. And it's really something where we try to really be an active player in and aligning the interest of growing or being a support for the growth of the company, while not interfering too much into their development itself, but much more adding some capacity to that. We are really here to deploy the maximum of resource that we can. And the real view is more than 20% of our resources are then dedicated at that. Okay, so I think it's a brief overview of Aster. We have made maybe to finish with more than 50 investments over the past, and we are currently investing in the current fund that we have closed recently. That's all on my side for the time.
All right. Thank you very much. That's very helpful. Thank you, Jean-Marc. Tom, I'll turn it over to you for some introductory remarks. Tell us a little bit about Digital Lumens and your story in connection to strategic partnerships.
Yeah, thanks a lot for having me, and welcome to the audience. So Digital Lumens is a leading provider of intelligent LED lighting systems that provides a really phenomenal entree into the smart building marketplace. The idea is that we install within very large industrial and corporate facilities intelligent LED lighting that has smart characteristics in terms of compute power, networking, control, and we take those together to drive down energy use to illuminate the built environment. But as importantly, we have a wonderful catbird seat up at the top of the ceiling to deal with what happens inside that building. The company was founded in Boston in 2008, and I'm calling you from our headquarters in corporate Boston, which of course has undergone quite a transformation, as has my company. And as you suggest, in the fall, we agreed to be acquired by Astra, a global provider of intelligent LED lighting solutions, and they're investing in the Digital Lumens corporate headquarters as their innovation hub in the Boston area, basing off of a large New England workforce that already existed in the region. The Digital Lumens story is one of a broad spectrum of investor types, and everything from angel and seed investors to traditional venture capital to family offices to the topic of this conversation, corporate investment with Astra Capital and Digital Lumens being the two in the case study. In every case, when you are considering investment, certainly there's the financial terms that people spend a lot of time concerned about, valuation, preferences, payout conditions, ownership, and the like, which are all critically important. But as important across that spectrum of potential investors as you consider your options are what are the other intangibles that investor can bring to the business. Do they have a certain strategic view on the marketplace? Do they have a network of connections that will help you round out your executive team? Do they have corporate and customer contacts that give you insight? Or are they just great company builders that can help you scale a business from very small to scalable and help you approach a variety of exits, of which ours was acquisition. In the case of Aster and Jean-Marc and his team, what we saw from Digital Lumens was a very close alignment with the Aster platform about how the market was going to transition, how the built environment would go from having simple devices to smart devices, and that the connectivity of those smart devices would drive a new set of insights based on data analytics and deep understanding of what was happening in the environment. So we had a partner that had an aligned view of the marketplace and had made a broad set of investments in that space. Additionally, Astra brought with itself a set of anchor tenant investors, of which Jean-Marc listed off, and in particular, one that was important to Digital Lumens was Schneider, which is one of the leading building intelligence firms in the marketplace. And throughout the life of our company and in partnership with Aster and Schneider, we're able to get great insight into how to proceed and how to go forward, and had value delivered to us well beyond the sort of financial investment that Jean-Marc and his team graciously provided.
Great. Well, thanks so much for that, Tom. I guess to kick things off, I'll follow on something that, Tom, that you were saying, and that is on the intangibles. And I guess this question is both to you and to Jean-Marc, but with respect to the intangibles and what intangibles a strategic investor or investor like Astra brings to the table, how do you think about those in relationship to the economic factors that often drive investments? Do you sort of screen investors or screen portfolio companies for one before you get into discussions about the other? Or are they really a pair that go together? We're thinking of where the next opportunity, where the right partner might come from.
I can go first, Tom, here, and then interested in hearing Jean-Marc's perspective. I think there's a couple of different types of strategic investment scenarios that may be in play. One scenario is where the strategic investor is the sole or major investor in a round. The other is where the investor is essentially part of a syndicate being built up through traditional financial investors, and ours was the latter case. I think in the former case, I think there oftentimes are concerns about valuation and are you giving up something in the business for that investment. But in the case of where I think you've got a full syndicate, the strategic investor plays both a financial and a company building role in the investment. In terms of our considering Aster, and of course this is a two-way street. Jean-Marc considers many portfolio companies before he makes an investment, and of course growth companies consider many different investors to understand who could best build their businesses and whether there's actually an appetite to invest in their go-to-market strategy. And I think that what we saw was really proof in the pudding from Aster, where that one of the concerns I think with corporate investors is whether or not they truly do have the ear of the corporate customer, and not that they direct activity, but do you get a good insight into strategy? Are you welcome to present to the senior decision makers? You're never guaranteed a piece of business or a partnership, but you certainly want a investor, in the case of strategic, that is respected within the larger corporation overall. And Astra, which is actually almost an arm's length related to its anchor tenant LPs, has a very remarkable ability to bring insight and small companies together with its large LPs, dedicated business development staff that helps pathfind and seek out those opportunities that matter. And, we had, I think, an extremely productive, efficient, and profitable relationship with Aster throughout our time.
Jean-Marc, how would you, how do you think about those issues when you're, as you said, as Tom said, looking at the range of potential portfolio companies across the desk, and what sort of value add and growth function you can add to those?
I mean, we have to be clear on one thing is we don't select companies to do partnership. We do select companies for their capacity to grow and capacity to make something happen within the market. On top of that, we try to build on partnership capabilities to help the company to grow and to strengthen the capacity of the company to have a reach, to have recognition, to have leverage from large corporation recognition. But I don't see really an issue on this point, because it's not to take the companies our direction, it's much more to support the growth of the company. So this being said, the way we do it and the way we facilitate the life of companies is a little bit leveraging also the resources of partnership, because people at the business hub in Aster are people coming from the corporation that are seconded to us and who have a clear and detailed understanding of the corporation where they are coming from. And they are really, it's easy for them to knock at the good door or the right door to be able to introduce the company to the person that are probably the good one to be either decision maker or the one interested into the, let's say, technology or the offer. So we try to really shorten the distance between a corporation, which can be very complicated to understand from a startup perspective, and the stakeholder in the small company. But we don't want to interfere too much on the strategic positioning of the company for that.
So Jean-Marc, it sounds like you view it as truly as a value add, not as a core driving aspect of how you invest. Your relationship, that is your relationships with strategics and potential customers and partners. The core business has to be strong and has to be viable. The team has to be there. The market has to be there. Is that fair?
Yeah, I mean, what our belief is really the main learnings for corporation. I'm not talking about strategic, but learnings are coming from the fast change within markets. And these changes are provided or supported by this kind of high growth companies. So Decisionmaking being one of them. I mean, the company has been able to create some new ways to sell lighting control, smart lighting in some dedicated niches or market segments. And this was not for granted and not that easy to understand from corporation's perspective. This is a change. Afterward, there are learnings from corporation coming from that. There are probably strategic positioning or strategic decision that they are taking from that, which is nurtured by this kind of either partnership or a relationship. But it's not something where you know for granted at the beginning of the relationship that everything has to be settled at first. I mean, we are talking about change management here.
It's interesting. So what, this is a question both for Tom and for Jean-Marc. When Digital Lumens and Astra Capital came together with the partnership and you started thinking about what sorts of specific activities could Astra engage in that would give Digital Lumens and Advantage. How did you approach that thought process, and what sorts of activities were most salient for you two?
This is Tom. I think that for us, one role that Aster had unique in our portfolio, it was our only global investor, and I think that was one of the key areas that we sought to leverage. Jean-Marc mentioned the various locations of his firm, and sort of a Eurocentric view, but outposts in other parts of the world were important to us. I think additionally, their time in the marketplace around the built environment, which has some very, very large players who've been in the marketplace for decades, and our approach to be sort of a combination of both disruptive and a collaborator with those entities, and how to best position were some of the areas we spent time understanding. And then then we had opportunities to meet with parts of their existing portfolio, a role that a traditional VC would also play, of who else is in the portfolio. If you're on strategy with the platform, and we certainly were with Aster, there must be others in the portfolio that should be investigated to see if there's opportunities to collaborate. And Aster has made other investments in the space, and an opportunity to share knowledge with the companies directly to understand how we could proceed. And so I think that we found ourselves immediately working on a wide variety of trajectories to figure out how we could add value, how Astra could help us scale and grow and deliver return value to their investment. And I think it was a really, again, an efficient and profitable relationship.
And Jean-Marc, when you were meeting with Digital Lumens and talking with them about what sorts of value add activities you could engage in, what sorts of steps did you think about taking to really advance that, as you said, those opportunities, not to drive them in a particular direction, but create opportunities for the business?
I mean, when we started discussing with Digital Lumens, we were not clearly stating that we will do those specifications that have been made. We were, let's say, planning or forcing that we could do something, but honestly, we didn't. Let's say, probably we commit to Tom, but it was maybe not well documented, and it was really trying to support relationship and building relationship with people at the corporation, which have later become a fruitful partnership. But at first, it was just the understanding that we had from the business development that Digital Lumens was in, that could have an impact on some markets, and those markets being potentially or largely addressed by the corporation, especially Schneider Electric. So there was probably a leverage, but we didn't really tested or validated this opportunity before investing. It's much more through the investment that we try to really make this happen.
Mm-hmm. I think that's a really good point that Jean-Marc is making, and I think it sort of that subtlety to the decision-making process is important across all different vectors. Astra made a decision to invest in Digital Lumens on the fundamentals of its business. We made a decision to take an investment from Aster based on the fundamentals of the investment, of which the strategic insight was, of course, one. Any of the portfolio or platform players in Aster's business make decisions on whether to work with Digital Lumens or just take a nice meeting based on whether or not it works for their business. And there's no quid pro quo. There's no guarantees. I think it is just one in which you have a shared alignment and when your belief in a way a market will mature, an experience set that can be brought to bear on that shared vision, and then you have to execute. But I think in each sort of pairwise decision process, you get down to the fundamentals before you go forward, and nothing is guaranteed, but you do have sort of the access to having the conversation to decide whether or not those things should happen. I will make one other comment about Aster that we took advantage of was really access to, almost what I call a business development resource, somebody who thought deeply about the marketplace and how we would fit there, and always felt that there was somebody in the marketplace looking out for activities either in its platform or across the marketplace, and would draw our attention to it and suggest opportunities. And when you're a growth company and you're fast charging, oftentimes you can't keep track of everything, and even the most potentially lucrative or partnerships sometimes don't get the resourcing that they require. And the fact that Aster has a thesis of putting smart people on the problem, made us more successful, and I'm sure has made others in their portfolio more successful.
And Tom, when you were thinking through those things, whether it's the business development functions or the other value add, there's a lot of noise in the marketplace about what it means to have value add service from investors, and it sounds like these really are the intangibles, or not things that you put into the term sheet when you were working through them, and they're sort of based on the relationship that you end up having with the investor, to the extent you can extract those value-add services. But how do you think an entrepreneur should think about what are the categories of value-add that are important to a business? Is it the business development function? Is it the access to global markets? And how might that differ if you're an early stage versus a growth stage business? Does that change over time?
I think it does, and there's a broad array of services, company backing firms provide, and it's changed over time and over generation. There was certainly a time during many of the boom years where just simply getting a company off the ground was a challenge, and you had venture capitalists offering HR services and real estate services and the like. And I think those sometimes for very, very young companies can be interesting. I think where if you have a team that to some extent has done it before and of course can always learn more. I think the services that it really come from insight into how markets will progress. The subtleties of a market, particularly markets that have been around for decades, if not centuries. One of the challenges I think with clean energy is that many of us are trying to reshape century-old industrial and commodity marketplaces, which is a different challenge than putting a new app on a smartphone, which is completely a greenfield opportunity. And having partners that understand exactly how those markets are run and what the unwritten rules are can be of great help. I think across all investors, I think classic company building, access to customers and partners is always required. Help in retaining and attracting good talent, and then finally, the ability to support the company going forward, both with his own financial resources as well as encouraging others to participate.
And Jean-Marc, when you think about looking at portfolio companies, potential portfolio companies, early versus later versus growth stage companies. How do you think about the types of strategic services, value add opportunities that you help them with, and does that change over time as the company grows?
Yeah, I think over the time, what you get or what you can support the company with is really depending on these value add, as you mentioned. And when you are talking about early stage companies, recognition, market recognition is probably one of the first elements. So companies need to highlight some names or partnership that might give them some early recognition. Probably the first customer is one of the most difficult ones to get. So this we try to bring. Later on down the road, I mean, when the company expands, it's also going beyond the markets or segments and geographies. So it's really following the growth path of the company and trying to go or to support the company where the main growth stake was. I mean.
One thing that we hear a lot, and I think you both have mentioned this to some degree today. A lot of entrepreneurs have concerns that if I enter into a strategic partnership, what does that do for me down the road? What, ROFRs on sales of the company, other sort of restrictive rights, having a strategic on the board, does that limit me in terms of my future investment opportunities, in terms of my exit and M&A opportunities? How do you two view that? Is that a real risk? Is it not a real risk? Does it depend on the stage, maturity of the company, the type of relationship they have? What's your view of that? Jean-Marc, maybe I'll start with you.
I think the strategic partnership here is not really putting at risk the company liquidity or exit. It's much more the rights that any kind of investor might have and might create some difficulties for liquidity. I mean, in this specific case, I mean, we were the partnership that we put in place was not really creating any concern. The fact that in the life of a company, it has to go through an exit is clearly part of our focus as an investor, and we are supportive for that. And in the exit, I mean, the partnership might be a way for the partner to become the acquirer or not. And for me, it's not something which is creating problems from the partnership itself.
Mm-hmm. And Tom, for you, when you think about screening a deal for its future impact on value, future impact on liquidity, how heavily do you weigh that, and to what extent does that drive your thinking of when, if a strategic partnership is the right choice for an entrepreneur?
Yeah, I think that I think there's a general anxiety, I think, amongst some company builders that a strategic investor has the set of benefits we have just been speaking about today, but I think there's also the concern about whether or not it has a real or implied impact on your opportunities. I think the real impact, of course, is defined by the relationship between the entity, its role on in corporate governance and any terms that may be in the the funding documents. The other, I think, is the one where, you know, I think it just is as concerning, but I think probably not, it should not be, is does an outside firm look at a company and see an investment from one of its competitors and say, I really don't want to talk to that firm because I believe, or I think that there's a right of first refusal, or some of my strategy will end up getting leaked to this strategic. And I think that, you know, we're certainly an example in terms of our exit. I think there are many where the strategic was part of the company building. And help drive a financial outcome, but where the options were left available. And so, you know, my guidance would be, you know, to understand, you know, what the intent is of the investment. And I think you've heard in the case of Astra a broad set of intents in terms of company and market building. You know, you have frank conversations about what would happen if a third party comes in. What are the rights around recusal or information sharing that allow the financial investor to be a participant in decision making, but not stand in the way of an important outcome for a relationship? And so I think that you know, unbalanced strategics are important and a welcomed addition to the investment community. They provide a set of unique opportunities, insights into how markets act and will change, as we just discussed. And so, as long as that, you know, all the cards are laid out on the table, and the transparency around what ifs are involved in the funding and the actions of the business during partnerships and potential transactions is clear, I think sort of the historic arguments against strategics begin to diminish.
One of the things we've seen in some of the deals that we've been doing recently that involve strategic partnerships, either with a company that's seeking an exit, has an existing strategic investor, or is looking at a new strategic investor where there may or may not be an existing strategic in some role in the company, is at least on the growth stage companies, we've seen a somewhat of a trend away from the classic right of first refusal toward rights of, you know, first negotiation or rights of notice of future investments. As you said, Tom, frank discussions around what should a strategic's information rights be, and those are making their way into the term sheets and then into the investor rights documents as heavily negotiated considerations. Do you think have you seen that? Is that something you've encountered? Do you think that's something that entrepreneurs should be more mindful of, or is it just a function of what stage company you are when you seek those?
You know, I think that's certainly, and Jean-Marc has seen more term sheets than I have, so it is better informed. And you know, I'm certainly has been in deals where there are strategics other than his. I think one of the things that's unique about Aster is, while it does have anchor LP tenants that are strategic partners, it is not in itself an investing arm of a potential acquirer or partner. So I think that's a bit unique. So I don't have firsthand experience on the, you know, what terms creep in, but I think that you know, of course, that's you know, terms are important, right? And I think oftentimes are less understood going in than are the valuation terms, and probably need to be discussed quite early in the mating ritual between the company and the investor pool, because it's, you know, you want to have those conversations when each side has leverage before you start versus while you're in the midst of just trying to clean something up and bring the cash in, or consummate the investment in the case of the firm. And so I think you know, as I'm sort of repeating myself here, but you know, just clarity about what the intent is, I think is important, and certainly, you know, Jean-Marc, I think, you know, probably has more, or certainly has more experience than I do around the range of terms that he's seeing in his deals.
Yeah. To answer directly your question, you are right. It's getting more and more common to get this kind of right of notice especially now it's appearing in side letters. So it's not in the proper documentation of the company, but much more between the company and each investor. But honestly, I think it's more or less useless because it tries to cover something. When you sign the documents, you are trying to forecast what will happen in the coming years. And when the company is going for an exit, honestly, in any kind of process, let's say the strategic partners or any kind of interested parties, they will be contacted. I mean, you need to find an exit, you need to find the best offer. In the case of Decisionmaking, I will not to talk about the details, but we were not focusing on only one. I mean, obviously, you need to get more people at the table in order to make sure that you get the best offer and also select the offer which is the most suitable for the team and company. I think, Tom, I mean, it was part of that. I mean, you are not selling, it's a company, it's made of people. And then that's important to make sure that you have a good coverage of the offer. So all these kind of notice, right of first refusal, are mostly made to make people feel comfortable when they commit the investment. But most of the time, it doesn't really create a good momentum for the LP or for the investor for the exit. Honestly, I never seen it properly done. Right of first proposal being much more a way to avoid to get an offer, because sometimes the competitor, they don't want to put an offer because they don't want to create an opportunity for the competitor to buy. So I'm not so sure of that.
That's very helpful. Thank you, and appreciate that experience. We've got a number of questions from the participant group here. So I'd like to switch gears a little bit and start going through some of these, if I may. The first question here is for Jean-Marc. Jean-Marc, did Astra Capital look at competitors or parallel companies to Digital Lumens when it was making its investment, or was it more of a bespoke search for the right fit? Were you looking at that space, or were you looking more specifically at Digital Lumens?
We look deeply in the lighting business. So I think we review more than 200 companies, not related to digital Lumens, but more to the lighting and lighting control space. And in the field of lighting, we invested in 2 companies which were not really competing, having different perspectives, different markets. But in all this review, we call it market reviews at Aster. It's deep dive on the market in order to understand where are the opportunities for small companies to enter a market, where is or what is the best position in the value chain to do it, and what is the most sustainable way to do it. So it's not only a technology play or any kind of offer play, it's also trying to forecast what will happen in the coming years if the company is successful to create an opportunity for an exit. So yes, we review a lot of companies, and we selected to go more for the one developing the features and the control, rather than being more at the pure LED level. So in the case of Digital Lumens, it has been quite positive.
Thank you. The next question I think was directed to Astra, but I'd like to actually ask it to both of you in a little different way. Question is whether the partnership or the investment comes first. Are there situations where you might form a strategic partnership and that grows into an investment from the strategic partner, or does it almost always or typically begin as an investment with a value add strategic opportunities.
For Aster, it's all the time, or at least mostly, we do an investment with and foreseeing that we might be able to do a partnership. If you do that, you are creating an opportunity to create something that didn't exist before. If it's only financing a company which has already a partnership, it can be done, but we will not create a much higher leverage, at least from the partnership already signed. So most of the time when people are discussing this, it's much more to glue the partnership. It can be, but it's less common in our perspective.
And Tom, from your perspective, are there scenarios where you've thought either with customers or other non-investor partners of approaching them, building a relationship, and then working from that to maybe a capital investment, or is it simply the case that it always works as an investment with the value add of the strategic relationship?
I certainly hear what Jean-Marc is saying, and indeed was true in the case of the investment by Astra in Digital Lumens. In prior companies, I've taken investments from in a specific case, I'm thinking about a customer who had made an initial investment in the business, was taken with the initial impact we had on that customer's business and introduced us to the venture capital arm. And so I think probably that's a relatively common sort of traditional corporate investor where the business operator is beginning to use or is considering a new company, introduces it to the venture arm, while the other direction is also possible. In the case of Aster, it's part of if you're just making an investment and you're adding nothing new because it already exists. I think that's it can maybe change the characteristics, but I've seen it go both ways, and I think both should be considered. And as you know, and I think we talked about, both Jean-Marc and I have been pretty straightforward that at every junction, the growth company and the large either LP or corporate investor business unit has to agree that this is a useful technology, and it doesn't help the company to get a pity order or for the corporation to invest in a technology that doesn't further its own initiative. So I've seen it go both ways, and I think it's all should be considered. But that's at least my experience.
Great. The next question we had is again for Jean-Marc. How does Astra balance the interests of its various portfolio companies against the interests of its corporate LPs? Do you have to juggle any conflicts in those in terms of what's in the best interest of each, and how do you manage that?
I don't see opposition. I think just to explain what corporates are looking for through a venture activity, either a pure corporate venture or any kind of Aster-like or direct investment in VC fund. Most of the time, they are not only looking for portfolio companies, even though people are, let's say, keeping this in mind because this is the more visible part. But honestly, most of the time, the most interesting part for corporation is much more to try to understand what is happening in the market, what are the factors of changes, transformation, what are the threats that might become opportunities, where to position the company, where to go, which partner they can be working with, and so on and so on. So the fact that we are doing some partnership with some companies, the interest behind that is if the company is going very fast, the partnership is fruitful. And it creates some more opportunities for corporation to understand, to adapt, to move to that. let's say to make it very simple, corporations are engine of efficiency, but it's very difficult for them to adapt to the change of markets, whereas startups are much more adaptive to the changes, even though they might not be that efficient at the time when they are startups. So, and by making these two worlds work or be closer together, there is a good supportive element.
That sounds like a really kind of an elegant way of encapsulating some of the advantages of strategic partnership is using those two complementary growth functions. And I wonder, you know, that and relating back to something Tom said earlier, you know, whether there's a difference in how the venture arm of corporates versus the business, let's call it the business commercial arm of corporates, think about these partnering opportunities. And if you find an advantage or maybe a timing difference in working first with the business arm and getting that team engaged and interested, does that facilitate how the venture arm of these corporate strategics, investors think about their investment opportunities? Do those two talk? Does it help kind of cut through the sea of term sheets they see? How do you two think about those issues?
Yeah, one thing that I saw with Aster and then, you know, that worked well, and then others where I've seen it not works well, is that if the venture side of the business is calling into individuals with whom they've had prior conversations and understand the business challenges, the business needs, what's covered and what's not, the glide path for the growth company into that conversation is much stronger versus calling up and saying, you know, by the way, we have the same corporate parent, we've never spoken of before, would you mind taking a look at my portfolio company? You know, almost as, you know, almost a corporate version of LinkedIn. That's, you know, I think that you know, what we've seen, again, and Jean-Marc can talk about his own process, but, you know, both with Aster and other strategic investors, I've always seen greater results from the growth company's perspective if the venture firm or the venture investor and the business operator have had prior conversations. And so it's just, you know, you're not just throwing something over the transom and hoping that this is a fit, but at least there's been some investment on both sides to understand the needs and opportunities. Because it doesn't really help the growth company either to just be tossed into a conversation with an unwilling participant or a participant that isn't fully vetted on what you're doing either. And I think that's critical. And whether or not that's a formal process or becomes from relationship, or whether or not the individuals in the corporate function have been part of the business function in prior lives, I'm not sure exactly how Aster runs it, but I think all are possible to create an easier and more more interesting conversation.
Would you agree with that, Jean-Marc?
Where if you try to build a business relationship before the investment, it might work, but it's much more short-term perspective than medium-term perspective. And you don't grab or you don't encapsulate in the partnership what the company can do and develop on the go. I mean, when we first met Digital Lumens, I mean, the company was probably nothing to do with what the company was 1 year later. I mean, things are changing very fast in the company. So this is the most important part. The change created by this company is an element of interest.
Mm-hmm. Well, we're getting close to 2 o'clock here, so just being mindful of everybody's schedules and appreciate everybody making time for this. I think we'll go ahead and wrap up. As I mentioned at the top of the call, the slides are not going to be made available, but this is being recorded, and a link will be sent around. I think it will be posted on the council's YouTube channel as well. So to keep an eye on your email for that. First, I guess thank you to Tom and to Jean-Marc for joining us today, for all of their time putting this together and sharing their thoughts and experience with us. I know I've gotten a lot out of it, and hopefully everybody else has as well. Thank you to the sponsors that make all this possible, Mass Clean Energy Center and NYSERDA, for all the work they do for accelerating the ecosystem. Thanks for the council for putting this on and for letting me be here today. And thanks most of all to all the participants out there today. We appreciate your participation. We appreciate your questions. A reminder that this is part of a series of webinars. I think as up on the screen now is the webinars number 3, 4, and 5. Also look like they'll be extremely engaging, all on the same theme as we were discussing today. So with that, thank you all, and look forward to connecting in the future on other webinars. Take care.